Kapil, coming on that, thanks for joining, of course. And coming on that, the way crude has behaved in the last few days, and of course, what happened on Friday, whether at Ukraine or in Iraq, is a separate matter altogether. But with diesel under recoveries also going out after the course of the next price hikes, how big a positive, if at all, could it be?
That's true actually. The crude oil prices rise over the last, especially in the early part of the recovery post-Lehman, the rise in crude oil prices along with commodity prices has been one of the problem areas, both in terms of inflation, current account deficit as well as fiscal deficit. So oil price correcting is a big macro positive, definitely for a country like India, on all three parameters, whether it's inflation, current account deficit or fiscal deficit. So if it remains contained or falls further below, I think macro dynamics will improve simply because of that as well.
Kapil, how did you read the trade data, particularly because we have the export-import policy due by the end of this month? So what kind of policy are you expecting? Will there be any SOPs offered to particular export sectors, particular export markets? Because we've tried numerous, what shall I say, tweaking of the policy in the past. What kind of policy are you expecting?
On the first one, on the trade data side, I think by and large on expected lines, there was in any case some moderation expected on exports front from 9-10% range to 7-8% range. That's what we expect going forward as well. What is happening on export side also worth highlighting is that agriculture exports are slowing. At least the last one data suggested that agriculture exports are slowing. Manufacturing exports still did well, but agri exports are slowing, and so in the near term there is some cause of concern on that front, that if agri output is weakish because of the rainfall activity, then agri exports will be hit. So having said that, we are not anticipating any sharp jump in trade deficit despite exports weakness. In any case, gold imports coming below $3 billion as was seen last month is also a big positive. So trade deficit in any case looked at from any angle, I don't think it's a worry at this stage. Only thing to watch out is how the external demand, Europe, UK, China, US, some of the key trade partners, how it pans out. Of late there was some weakness reported in the European data. UK wage data was also quite soft. To some extent US retail sales were disappointing. So we need to see how this pans out. So what possibly has happened is that in Q1 of this calendar year, because of the extreme winter condition, our exports were weak, the external demand was weak, and then there was it was pushed into Q2, that is June quarter, and where our exports did well. And let's see how Q3 pans out. So I think 7-8% kind of exports momentum is good enough in my view. What we've seen over the years is that currency weakness is certainly a help, but the key driver of India's exports at this stage from near term to medium term perspective is external demand. So we need to have a watch on that.
Kapil, IIP data has been notoriously volatile, but even so, what sense does one make? Is there some dissonance really between the IIP data that one has been receiving for the first quarter, particularly in the last month, and then what we see as far as profit margins of companies are concerned? We are seeing repeatedly stories, across business newspapers that the first quarter has been very good for Indian companies. So why is this not reflecting in the IIP data? Why did we see a dip from 5% to 3.4% in the last month?
I think what is happening on industrial activity front is that, first of all, I think Q1 is seeing from recent history of last 2-3 quarters was a very good quarter for IIP at close to 4% growth in Q1 is a good number relative to history of last 3-4 quarters. So there has been a sharp pickup. If you look at on trend, now obviously as you said, monthly data is very volatile and it's the trend underlying trend which one should monitor. There what we are observing is that if you see the trade-oriented industries, whether working through import substitution or export sector right away, those industries are doing relatively better. For example, chemicals, refined oil products, engineering goods, they are doing very well. Whereas the domestic demand-oriented industries are not doing as well. There is a clear divergence over the last several quarters. We have seen maybe last 4-5 quarters that this trend is happening. and that's exactly what we saw in last month as well. So weakness was largely centered on domestic demand, not so much on export front. This trend is not surprising also, by the way, which is to say that, you know, if domestic demand levers, particularly high domestic inflation, very tight fiscal policy, and tight monetary policy. So a tight macroeconomic policy along with high inflation is squeezing the households. So to that extent, domestic demand weakness is not a surprise, although one would say that, you know, some uptick in consumer sentiments did help in the previous month, but we need to see whether that alone is sufficient to maintain the momentum seen in the last month. So overall, I think this divergence will continue. The only strong lever for industrial activity at this stage is external sector, not so much the domestic sector.
Okay, speaking of the external sector, you know, we've just seen FII flows have been very strong in the first quarter, but recently they are reported as far as investment in bond is concerned, FII, there seems to be an outflow. Now, is this a portent of things to come if and when interest rates reverse in the US close to the close of this year? So are our funds really preparing for it already? Are they withdrawing in a minor way? So we'll see again the repeat of the same phenomenon. Equity flows stay, but bond flows go out.
Absolutely. I think Fed, when it normalizes the policy, which it will do after a very, very long period of time, that is one barrier which the global markets, currency markets, equity markets and bond markets will have to cross. Historically, if you do some analysis of previous Fed rate tightening cycle, let's say 1994 tightening cycle and then 1999 and then 2003-04 cycle, the most disruptive was 1994. It wasn't the case in 2003 though, when Fed started to tighten, but it was not so much disruptive for emerging markets, currencies or equities. I think what differentiates between a whether calm reversal in the policy or a very sort of knee-jerk reactions by the market is the expectations. If the expectations of the markets are well managed by the Fed, I don't think reactions in the emerging markets, currencies including India, would be that sharp. QE, for example, last May 2013, when Chairman Bernanke first highlighted that Fed is gearing up for QE tapering, it was largely an unexpected move, and therefore the reaction globally was very violent. But as I said, there are previous cycles in which Fed started to tighten, but there was little impact on emerging markets. So how Fed manages the expectations, are markets ready for Fed tightening cycle? That will play an important role in what will be the reactions of the market to the Fed tightening. And in this case, I am on the optimistic side that the Fed will be preparing markets well in advance before they embark on the tightening cycle, and to that extent market reaction will be spread out over a period of time and in small bouts rather than one big bout of volatility of 5-6 months.
Okay, interesting thoughts both from Kapil as well as Metli, and take a moment to thank both of you for joining in on this discussion and giving us your views. That's of course the macro. I think the one thing aiding, of course, the macros is what crude is doing. It is very volatile, yes, but for now I think it's aiding the market sentiment as well. 7830, so 10 points adrift of those all-time highs. I mean, give or take 10 or 11 points adrift of the all-time highs.